After a wild 2022, Tesla reports fourth quarter earnings on Wednesday after the market closes. The stock price got hammered in the fourth quarter, losing about half its value in 3 months, on the back of headlines saying that Tesla has run out of demand and Elon Musk is upsetting people on Twitter. But now we'll get to see how Tesla's business actually performed and what Elon Musk has planned for Tesla's future. So far in 2023, Elon Musk has made a drastic move to cut prices significantly across Tesla's Model Y and Model 3 lines so that consumers can gain access to the $7,500 Inflation Reduction Act tax credits. Tesla's price cuts are not only a huge benefit to consumers, but just the news of the price cuts have acted as free advertising for Tesla to let people know of these newly affordable vehicles. Every media outlet on the planet has been talking about them, and whether in a positive or negative fashion, it certainly brings to people's attention that Tesla's cars may now be ripe for the purchasing. If Volkswagen, for instance, cut prices on their cars, no one would really care. Now, Elon Musk has been using the recession playbook as he believes that the Fed's continued interest rate increases will cause a major slowdown. Any vehicles that are financed or leased have now become more expensive for consumers now that interest rates are much higher. This affects all car manufacturers who are already struggling with supply chain issues. And so Elon Musk is putting even more pressure on Tesla's competitors by lowering price at a time when the competition continues to raise prices. Tesla's price cuts are in a sense a paradox, because in order for Tesla to lower its costs, they need to build and sell more vehicles, which allows them to take further advantage of economies of scale. But in order to sell more vehicles, they need to lower the cost to spur demand. And so instead of being stuck in this infinite loop, Elon Musk has decided to reduce the prices first and take a short-term hit on profits and margins, but this will help Tesla in boosting production without worrying about demand. Plus, Elon Musk sees prices of commodities and other inputs dropping across the board, and so it's likely that combined with Tesla's factory improvements over the past year, the cost to produce a vehicle is falling rapidly. Now, demand for Tesla vehicles certainly has bounced back. It looks like Tesla already increased the delivery times on some of its models, and they even raised the price of the long-range Model Y by $500. To me, this makes it seem like the price cuts weren't just completely random for the sake of lowering prices. Model Y long range was actually reduced a few $1,000s below the tax credit threshold. Tesla is well aware of their margins, and by raising price back up slightly, it shows that they are seeing high demand and are trying to balance the cuts with maintaining at least some reasonable level of margins. Now, this will also shock competitors who are now selling overpriced gas cars, since EVs are now cheaper in many cases on sticker price. Now, these price cuts won't really affect Tesla's Q4 results since they only occurred in January. Q4 was a tough quarter since many people had likely delayed their Tesla orders awaiting the EV tax credits. In the last week or so of the year, Tesla gave up to $7,500 off to spur demand and try to get as many vehicles delivered by the end of the year. That said, Tesla has been shifting to a smoother delivery schedule, which hopefully they discuss progress on during the conference call. This may be very important since it could be causing fluctuations in Tesla's inventory. As we've seen, Tesla's production has been much higher than deliveries at the end of each quarter and at the end of the year, as reported. So this could be a result of this smoother delivery schedule as opposed to weak demand. And if they have made progress on this front, then the reduced cost for delivery should begin to save Tesla a lot of money. By the same token, however, higher inventory may be more expensive, unless there are just a lot of vehicles in transit. So this quarter should hopefully give us some clues on that front as to what's really going on, which may dispel some of the high inventory issues that analysts play off of. Surprisingly, in Q4, Tesla delivered 405,000 cars, which missed estimates, but that was about 60,000 more cars than they delivered in Q3 when they were bursting at the seams, running out of delivery vehicles and paying exorbitant prices for deliveries. So they must be doing something right in order to be able to deliver that many vehicles at a time when everyone else is focused on the delivery miss and demand issues throughout the quarter. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and a brand new set of financial data going back 15 years, and it's all freely available. Now, looking at the financial statements, I've estimated Tesla's Q4 results. This will likely still be a record quarter in terms of revenue since the prices of cars remained high throughout the most recent quarter, and Tesla beat their previous record by 60,000 vehicles. Now, we don't exactly know how many vehicles were delivered after Tesla made some price cuts in December. The average selling price of vehicles in the third quarter was almost $52,000. And so I've used that number, but I didn't put back any emissions credits just to be on the conservative side. I think Tesla will still get emissions credits, but I'm trying to compensate for a drop in the average selling price of a Tesla, but the report may give us a clearer picture as to how that will affect revenue starting in Q1 2023. Now, I've left leasing about just slightly higher than last quarter and last year. The energy business should be growing nicely. I've made multiple videos on how Megapack Factory is poised to grow over the next few years, and Megapack has a massive backlog with new orders only estimated for delivery starting in about 2 years from now. That said, we haven't heard much about the solar business, which could still be dragging down margins in the energy division. In terms of service, I think there's always more cars on the road and more cars coming off of warranty, so I've increased this slightly. My revenue estimate is for $24.5 billion, which could still be affected by multiple factors that I've mentioned, but I've tried to keep expectations low by being slightly conservative in some areas. The analysts are looking for $24.16 billion in revenue, so I still seem to be ahead of them. That said, I think that even if Tesla beats on revenue or earnings this quarter, the landscape has changed due to the price cuts, so investors may be looking past these numbers and focusing on any clues for the future, which we'll touch on in a moment. In terms of costs, I've used the same proportions as last quarter for most of these numbers, or tried to keep the difference between revenue and expenses about the same. Commodity prices had started to come down during the quarter, although because of contracts and supply chain, there may be some delay before it gets into the numbers. I think there are more moving parts than usual in this quarter, though they could all cancel each other out in terms of revenue and costs. For instance, Tesla smoothing out deliveries should technically lower the cost in some areas, whereas the back half of the quarter price cuts will lower the revenue. I think if we do see costs drop in any way, specifically per vehicle, that would be a positive sign that Tesla is making progress or raw materials are coming down, which would be a clue for the upcoming year. My estimates show over $6 billion in gross profit, and if that's in the ballpark, it would be higher than last quarter's gross profits by about $800 million. Now, I've left R&D the same, SG&A is slightly higher. Now, I may be wrong here, but I think there could be a small restructuring charge, which is usually the account where Tesla puts their Bitcoin write-downs. The price of Bitcoin may have closed just slightly under their baseline during the quarter, so they could have a write-down, but if anything, it would be extremely small. I've kept the number at 0. Now, interest rates have been going up, so that could affect interest income and expense, though Tesla has over $20 billion of cash and almost no debt. So I arrived at $3.9 billion of net income and $1.24 per share of earnings. Now, I don't think that's overly bullish, and I tried to be conservative because really things could be anywhere this quarter. The analysts have lowered their own estimates and now reside at $1.13 per share. I'd prefer if the analysts were a little bit lower, since after all, Tesla's stock has gotten more than 2/3 of its value chopped off in 2022, and the estimates are down just a couple cents. Tesla did earn $1.05 last quarter, and again they sold 60,000 more cars this quarter. Even if every one of those 60,000 cars were discounted, but still contributed to profit, that should at least help Tesla beat last quarter's earnings. They sold 18% more cars this quarter compared to the estimates, which are just 7% higher. Now, as always, the quarter is just a snapshot of the past. Investors care more about where a stock is going in the future, and there may be some worry about price cuts, even though we've addressed their longer-term benefits in other videos. Loup Ventures' Gene Munster believes that investors are playing with fire, as Tesla stock has run up slightly going into the quarter, even though it's bouncing off the lows. Gene Munster believes there will likely be better entry points into Tesla, and Tesla can use this quarter to get everyone on the same page, as he says, meaning that there's still a lot of uncertainty around price cuts, and Tesla's margins could take a hit in the short to medium term. Now that said, Gene Munster confirms that demand for Tesla vehicles has in fact increased, but he's trying to temper expectations and excitement, which I like because it's better to be conservative and pleasantly surprised versus excited followed by disappointment, which is why Gene Munster is waiting for the quarter before making a decision on the stock. Now, one of the great things about Tesla is that they're always thinking long term, and when things get tough, you can always go back to the company's mission statement of transitioning the world to sustainable energy. It appears that there's still a lot more work to do on this front, and that's why Tesla is continuing to invest heavily in new factories and new projects. They just announced today a $3.6 billion expansion of Giga Nevada, which includes 100 gigawatt hours of 4680 battery capacity and a high-volume Tesla semi-truck factory. That amount of battery production could be used to build over 100,000 semi-trucks per year. That's also a powerful sign that 4680s are extremely promising, and Tesla is using a cookie-cutter approach to migrate their technology into each of their factories. Back in 2016, one of Giga Nevada's goals was to get to 150 gigawatt hours, and it only ever achieved roughly a third of that. Now, Elon Musk is getting ready to finally achieve that goal after years, with Giga Nevada being incomplete. But overall, because the story is far from over, Tesla's multi-year game is allowing them to set up even more investments today, which have basically nothing to do with this quarter's earnings results, but in the long run will drastically add to Tesla's earnings power. So do you think Tesla will beat analyst estimates for Q4? But more importantly, what other plans do you think Elon Musk and Tesla have in 2023 to ruin their competitors' plans and at the same time to boost their own production even further? Don't forget to watch my video on Elon's strategy with Tesla's price cuts. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.